As summer winds down and autumn looms, there is an unmistakable crispness in the air. But it's not just the weather that is changing this year. The economic landscape is shifting too, with a striking dichotomy emerging between the resilience of American shoppers and the creeping malaise gripping other sectors. The latest data paints a portrait that is at once reassuring and vexing. Retail sales surged in July, a surprise uptick that defied gloomy forecasts. At the same time, applications for unemployment benefits dipped to their lowest level since early summer. These bright spots seemed to momentarily quell the anxieties rippling through Wall Street and Washington about a potential recession looming over the horizon. It was, as the wags like to say, a proverbial shot in the arm for the guardians of economic optimism. After months of hand-wringing over the impact of the Federal Reserve's relentless interest rate hikes, consumers appear to be holding the line, almost defiantly. Their spending resilience has become the great paradox confounding policymakers and analysts alike. Consumers have become more discerning with their spending as they continue to face higher prices and borrowing costs. Sums up Lydia Boussour, the seasoned economist at EY. But the latest retail sales data shows a continued willingness to spend. The July numbers were, indeed, eye-catching. Total retail sales climbed 0.7% from June, the largest monthly gain since the heady days of early 2023. It was a broad-based rally too, with 10 of the 13 major categories notching increases. Auto sales roared back after a June slump caused by a cyber attack on dealerships. Electronics and appliances saw healthy upswings. Even e-commerce ticked up modestly, likely buoyed by Amazon's Prime Day discounts and rival promotions from the retail titans of Walmart and Target. This renaissance of the American shopper seemed to defy economic gravity. After all, savings accumulated during the pandemic have been largely depleted. Wage growth is cooling as the Fed's hawkish monetary policy bites. Many households are increasingly turning to credit cards and loans to sustain their shopping habits, a potential red flag about the fragility underlying the consumptive binge. And yet, the resilience persists. Even Walmart, that barometer of Middle America's economic well-being, raised its sales guidance, suggesting that belt-tightening has its limits. As Boussour notes, we expect increased spending prudence in coming quarters, though we do not foresee a consumer retrenchment. On Wall Street and in the marbled corridors of the Federal Reserve, this split-screen economic reality, robust consumer spending amid persistent price pressures and emerging pockets of weakness, has sowed as much confusion as relief. The upbeat consumption data, coupled with a deflating number of jobless claims, led investors to double down on bets that the Fed will begin cutting interest rates as soon as next month. The thinking is that gradually easing inflationary pressures will allow policymakers to change tack after over a year of aggressive monetary tightening. But not everyone is convinced the central bank will pivot so swiftly. Why? Because not all the economic signals are flashing green. Even as the shopper remains indomitable, other sectors are showing escalating strain from the Fed's punishingly high interest rates. The latest report on homebuilder confidence captured the prevailing gloom, with sentiment slipping for the fourth straight month to hit the lowest ebb of 2023. Escalating mortgage rates and still elevated home prices are taking their toll on construction firms, sapping their appetite for new projects. Similarly, industrial output fell by the largest margin since January, with manufacturing, that bellwether of economic virility, struggling against rising finance costs. Regional factory surveys looked equally grim, with activity sharply contracting in New York and Philadelphia. So we are left with a dissonant narrative. On one hand, the resilience of the consumer endures, seemingly impervious to the stresses of high inflation and interest rates. Families appear willing to keep spending, even if it means leaning more heavily onto credit to maintain their lifestyles. But elsewhere, the economic machine is starting to sputter and misfire. From homebuilders to manufacturers, the impact of the Fed's policy straitjacketing is increasingly apparent. It is the paradox at the heart of this confounding moment, the resilient shopper keeping the fires of growth stoked, even as the furnaces of industry are struggling with the monetary headwinds. How then does one square this circle? How to reconcile the diverging economic signposts that seem to be pointing in opposite directions? The optimists, of course, prefer to accentuate the positive. They see the robust retail numbers as validation of the core strength of the U.S. economy, even after years of shocks from the pandemic, supply chain disruptions, and the inflation scourge. At Bank of America, economists cheered the latest data as consistent with our soft-landing economic outlook, seeing the solid labor market as the bulwark keeping consumerism afloat. This rosier prognosis finds backing from administration allies who have long championed the extraordinary resiliency of the American economic engine. For them, the July spending surge is proof that the Fed's inflation-slaying campaign can achieve its goals without derailing the expansion completely. Some even dare to hope that the central bank's rate-hiking cycle may be nearing its apex. But there are others who see darker omens in the mixed data. To them, the dissonance between the spending binge and the industrial retrenchment hints at deeper fissures in the economy's foundations. While consumers may be keeping calm and carrying on for now, relying on debt to sustain their habits, this trajectory may not be sustainable if cracks start appearing in the labor market. Recessions, they warn, often arrive stealthily, with a lag between the tightening of monetary conditions and their full impacts rippling through the real economy. Today's shopper ecstasy, they caution, could rapidly curdle into a spending seizure if job losses start mounting and purchasing power gets further eroded. In this more ominous reading, the home builder doldrums and manufacturing strains may merely be the barely perceptible tremors presaging a more violent economic quake ahead. The resilience we are witnessing could turn out to be little more than a mirage shimmering over deeper structural fault lines. So which of these narratives will emerge as the dominant storyline? Will the indefatigable American shopper power the economy to that long-sought soft landing of moderating growth and inflation? Or are we witnessing the final effervescent glow before a new round of retrenchment takes hold? At this juncture, both tales seem plausible. The economic augurs have rarely looked so mixed, with hopeful signs interlacing with omens of potential peril. What is clear, however, is that much rests on the stamina of the consumer. For all the restive sectors and worrying signals, it is the free-spending American family that remains the irreplaceable engine of the U.S. economy. As long as they keep shopping, pumping dollars through the commercial arteries, the engine will keep running, however erratically. But should that consumptive life force falter, it's hard to see what could prop up growth. This makes the resilience of the American shopper not just an economic fascination, but a profound sociocultural phenomenon worthy of deeper examination. For underlying the data points and prognostications is a broader saga about the nation's deepest values and impulses. At its core, this is a story about the abiding faith of Americans in their ability to consume their way to happiness and fulfillment, even amid encircling economic storm clouds. It is a narrative stitched through the very fabric of the national identity, one that has been unconsciously passed down through generations. From the first post-war suburban migration that spawned the mallscapes of the 1950s and 60s, to the more recent era of online retail therapy and impulsive mobile shopping, the American penchant for acquiring goods and services has been an enduring constant. It is the force that fuels this capitalistic society, shaping habits, desires, and the very meaning of the good life itself. Deep in the cultural psyche is the abiding belief that more is more, that accumulating products and experiences is not just an economic exercise, but an existential imperative. To be American is to shop, spend, and acquire. It is the ethos embedded in every Black Friday stampede and instilled in every child's Christmas list to Santa. Even in eras of economic duress, this primal drive tends to reassert itself with remarkable alacrity. The boom years following World War II saw Americans gorging on big-finned cars, suburban homesteads, and the accoutrements of middle-class membership. The 1990s dot-com frenzy ushered in an acquisitive mania for digital gizmos and lifestyle upgrades facilitated by soaring stock portfolios. And in the aftermath of the Great Recession, U.S. consumers almost immediately resumed their free-spending ways once economic conditions stabilized, helping reinflate equity and housing markets with their unquenchable appetite for newer, better models of phones, cars, homes, and pretty much everything else money could buy. So in many ways, the resilience we are witnessing today is just the latest manifestation of this abiding national ethos. Americans' refusal to stop shopping, their willingness to pile on debt to sustain lifestyles, is the contemporary incarnation of an impulse that has propelled the economy through countless boom-bust cycles. Even the most extravagant shopper today would likely pale before the conspicuous consumption of the 19th century's elite millionaires, who flaunted their wealth with Gilded Age abandon. Or the profligate scions of America's industrial dynasties in the 1920s, whose indulgences famously inspired F. Scott Fitzgerald's most searing satiric depictions. But it would be a mistake to imagine this acquisitive ID as being quarantined purely within the upper echelons. Over the decades, the spending mania has steadily seeped into every socio-economic stratum, becoming democratized and more pervasive. Today, the middle and working classes spend with equal fervor on the spoils of affordable luxury. The latest iPhone, 70-inch flat screens, crate and barrel furnishings, and other emblems of belonging. It's a grand convergence of aspiration, with all cohorts now channeling their purchasive impulses in the name of cultivating a certain veneer of social status and material contentment. This phenomenon has been supercharged in recent decades by the rise of easy consumer credit access and innovative financial products like buy now, pay later services explicitly designed to stoke spending beyond one's immediate means. Not to mention the proliferation of targeted digital marketing that has turned even the humblest browser into an incessantly bombarded consumer battlefield. From a societal perspective, the effects of this consumerist ethos have been paradoxical. On one level, the expansive domestic demand and consumer confidence have been the rocket fuel powering America's economic preeminence. It's the sturdy underpinning that has seen the U.S. shrug off countless shocks and headwinds, from oil crises to natural disasters. But the flip side is an ingrained overconsumption that strains natural resources and contributes to soaring household debt levels, crippling financial fragility, and a culture that often seems to conflate happiness with possessions. Not to mention the parallel rise of a disposability mindset that has littered the planet with staggering volumes of discarded stuff. These costs, environmental, social, psychological, are rarely factored into the economic equations and growth models. They represent the messy, unexamined underside of the national shopping psyche. Yet, for the moment, this ID-driven demand remains the indispensable catalyst for the entire system. Which brings us back to the paradox of the present. At a time when so many sectors of the economy are wavering under the Fed's anti-inflationary blitz, the persistence of the American shopper feels almost like an act of defiance. Or maybe it's something more primal, the manifestation of an innate drive that has been institutionally reinforced over decades until it became a self-perpetuating dynamo. In the past, this engine of consumerism has consistently proven capable of resuscitating the economy in times of stagnation. The $64,000 question is whether it can summon that recuperative mojo once again to power the nation to the elusive soft landing.